and welcome to Business Incorporated Live on Channels Television. We'll be tracking the markets, the economy, and of course, we'll see how that impacts your pocket. Here are the stories we're tracking at this time. Zambia faces final review of its IMF Extended Credit Facility program. Egypt secures $570 million to build a 1 gigabyte solar plant. And in Nigeria, consumer markets operating costs set to rise faster than inflation in 2026. Great to have you join us for this half hour. I am Will Ibang. Let's check in on the commodities market and see how oil prices are doing this Friday, where they're poised for a second straight weekly decline as a potential supply glut and prospects of Russia-Ukraine peace deal offset concerns over disruptions from a blockade of Venezuelan oil tankers. Let's look at oil prices now. We see Brent down 0.45% at $59.55 a barrel, and WTI crude, we see that also down almost by a similar margin, 0.46% at $55.89 a barrel. Analysts are widely projecting a global glut in oil supply next year, and this is going to be boosted by increased output from the OPEC Plus producer group, as well as the United States and other producers. Now, uncertainty over how the U.S. would enforce President Donald Trump's intent to block sanctioned tankers from entering and leaving Venezuela tempered geopolitical risk premiums and is weighing on oil prices today. Venezuela, which pumps about 1% of global oil supplies, on Thursday had authorized 2 unsanctioned cargoes to set sail for China. However, Bank of America analysts are saying that they expect lower oil prices to curb supply, and which could stop prices from going into free fall. Let's look at metal space now. Gold prices that edged lower as markets digested softer than expected U.S. inflation data that came out yesterday. Now, U.S. prices rose, consumer prices rose 2.7% on year in November. Spot gold, we see that up 0.2% at $4,330.30 per ounce. Now, U.S. gold futures is down 0.2%. at $4,364.50. Now, spot silver, let's see how that is doing. Down as well, 1.5%, and that's at $65.30. And that's retreating from a record high of $66 hit in the previous session. Now, platinum is, however, up 1.2% at $1,922.05. And we see that palladium is also up 3.7% at $1,708.72 per ounce. That's nearly 3-year high. Still speaking of commodities, we're zooming down to Nigeria's consumer space, and that sector is recovering from the FX shock of 2023, but there's no single standout winner here. And this is coming from the Chapel Hill Denham report, which is showing us what to expect for the end of 2025 and also what to expect in 2026. We see inflation. Let's look at those slides very quickly. What to expect? We see FX shocks that affected companies. Near about 35% of companies held volumes through price changes, and we saw smaller pack sizes for some of this. Yes, very quickly there, we saw inflation peak in December 2024 at nearly 35%, and we also see, let's move on very quickly and see what to see prices also held up for some of those companies. We see them holding up despite the pressures that we saw. Revenue growth remains strong, and we also expect this to continue. We see that dollar, that free fall we had there between May and December 2023, and that free fall caused that FX cut and import bills to surge for these companies, and hopefully we see most of them recovering, and that's why we see acquisitions also took place in 2024. A lot of investors still coming into Nigeria, but what's driving all this despite what we're seeing in the economy? And we're going to be joined by an analyst from Chapel Hill Denham. Her name is Boluwatife, and she's going to be telling us what's going on there. Boluwatife, she's Ishola. She's a consumer sector analyst at Chapel Hill Denham. Good afternoon. It's good to have you join us.
Good afternoon. Thank you for having me here.
Boluwatife, looking at the reports that you put out there for the consumer goods sector in Nigeria, after that Naira's drop, what changes did companies make to keep their business running?
So so one of the things we saw them do a lot was reduce their exposure to FX, and we saw them restructure loans. For example, we saw Cadbury convert its $7.7 million intercompany loan to equity. We saw international breweries coming to the capital market for a rights issue to raise about 580 billion naira to settle outstanding loan. We also saw NB do the same. So we saw them restructure their loans to reduce dollar-denominated liabilities, but we also saw them, move to local sourcing. And backward integration is a major theme here. However, we saw them look for more accelerated methods by substituting raw materials. For example, we saw Unilever, start to locally source sorbitol that is produced from cassava starch, and rather than import sorbitol produced from corn starch. We also saw, Nestle announce that it was going to substitute locally sourced cassava starch. It was going to substitute imported corn starch for locally sourced cassava starch. So we saw it on two legs. We saw reduction of foreign exchange exposure from the loan leg. We also saw it from the input leg as well.
So which areas of the consumer goods are seeing the fastest recovery now? We've seen the FX issues, we've seen that devaluation and what it did to the real sector, but which consumer goods sectors are coming out of this quickest and why?
So actually, I think it's broad-based. It's not a particular sector per se. It's broad-based. Most of this consumer goods sector sort of follow the same strategy in terms of seeing how that they import some of their inputs, right? We have it on the brewer side. We also have it from the beverages side as well. So I think it's broad-based. It's not one particular side. Like the title of the report says, it's not a single hero story. It's actually across the consumer goods sector.
And so just wanted to know, looking ahead, what could help or hinder the growth in this sector over the next few years? Looking at your report, you're reporting a jump in growth for 2025 and also for 2026. But what could help it or hinder that growth in the sector in the next few years?
All right. So from the perspective of what the companies can do or what they're doing, what I believe they can do is much more product innovation, as we don't necessarily expect to see them increase, prices in near term, seeing as, despite this deflationary pressure, Nigerian consumers are still very price sensitive. We expect to see them drive volume growth from capacity expansion, as well as, increased marketing and distribution expansion. That's what the companies can do. Now, what would happen in the economy generally? We believe that, first of all, Q4 is usually a strong year. That's one of the near-term catalysts. Q4, festive season, people spend more on food during the festive season. So that will give them a strong Q4 and will lead to an impressive full-year earnings results release that will be released in 2026. That's one. But we also expect to see the MPC have a dovish tilt next year, which will mean there will be lower borrowing costs that will support CapEx growth. So we see that these two factors, that is, the festivities as well as, lower borrowing costs, would support this sector. But there exist downside risks, such as the pre-election year, which will typically put pressure on the dollar to increase the demand for dollar. We may see, also move back to a situation where the FX is further devalued. And another thing to note is that if the exchange rate appreciates, that is, the naira appreciates against the dollar, right, we may now see imported goods start to become competitive in the market again, competing with the local producers for market share. So, those we have near-term catalysts for the sector, but there also exist, some downside risks.
Boluwatife, you mentioned in your report that you expect the operating costs to rise faster than inflation in 2026. Why is that projection, especially for your estimated, what you expect in 2025 is that it should rise about 12.8%. That's below inflation. And right now for 2026, you expect it to be about 21.4% above inflation. Why do you have this projection? What are the factors that contributed to these numbers?
All right. So 2023, 2024, and partly 2025, what we've seen is that these consumer goods are trying to survive. That's what they are out here for, just trying to get out of the loss, trying to rebound, to recover from the loss. But moving into, if you look into their books, you see that most of the companies are already coming out of the water. And so 2026 will be a year for competition. Now, we're no longer just talking about survival, we're talking about growth. Now, we're fighting for market share. And in a situation where there is competition for market share, we're going to see intensified marketing. We're also going to see a lot of research and distribution. We're also going to see distribution expansion in a bid to, capture market share. We've already even seen that start in 2025. For example, for Nestle, we saw them spend 2 times more on advertising than in the 9 months of this year than they spent in the same period last year. Another example is Guinness, under their new ownership, expanding into the north with their non-alcoholic offerings, which we expect would increase the cost of logistics. And we don't believe that the other consumer goods companies will just sit back and relax. They also will be in the market, fighting for consumers' money. So we expect to see that, increase operating expenses.
Okay, you just talked about some acquisitions that took place. I just want to know quickly why multinational companies keep investing heavily in Nigeria's consumer market, even with the economic challenges that the country is facing.
All right. The facts are right there, right? Consumer goods sector is a defensive sector, right? And it has to do with volumes. And Nigeria has that in terms of population. We're estimated to be about 400 million people in 2050. That's a large population. That means volume right there. We also have quite a young demographic with a high urbanization rate, which means that, when people move to the urban areas, their propensity to buy packaged good increases. So we see that in terms of population size, in terms of demographics, as well as urbanization rate, Nigeria is right there, moving everything along. So, and that is one of the reasons why, or those are the reasons why the multinationals are staying in this country and reinvesting in this country. They are confident and committed to the market, and they believe in Nigeria's, consumption growth story.
Thank you so much. Boluwatife Ishola, consumer sector analyst for Chapel Hill Denham. Thank you so much for sharing your perspective and insights. And we'll possibly look forward to 2026, where consumer goods will be, dominating in the sectoral performance for the NGX. Thank you so much for your insights.
Thank you for having me here.
So now let's check in with other markets now. We see Egypt has secured a $570 million to build a 1 gigawatt solar plant with battery storage. Now the project is led by MAEA Power and Japan's Kyuden International. Now, funding comes from a group of international banks and development partners, including the IFC and Clean Technology Fund. Now, the solar plant in Aswan will be Africa's largest of its kind and is set to start operations in June 2026 and will power over 500,000 homes. Now, we're seeing Zambia is set for the final review of its IMF extended credit facility, or we could call it the ECF program. Now, the ECF is a loan arrangement designed to help Zambia stabilize its economy, control debt, and fund essential reforms. Now, the country receives funds in stages, and that's called the disbursements, which it has been, and it has to meet specific economic targets. Now, the International Monetary Fund will check Zambia's performance on fiscal discipline, debt management, and key reforms in governance and public finance. Social spending on health, education, and protection for vulnerable groups will also be reviewed by the IMF. Now, the outcome will decide whether Zambia gets the last tranche of IMF funding and will signal confidence to investors and development partners about the country's economic stability. And let's check in now with markets in Africa. That's the equities markets, and see how performance was for the NGX. We can tell you for free that is up above 1%, 1.12% at the time we checked. And it's now jumped. It's at 152,048 points. Massive growth there. We see First Old Coast still leading the charge there, and this is because we see Otedola, increasing stakes in that company. We see other banking sector, all this banking stocks also leading the charge there. And let's see news coming in. Staying with the NGX, the Central Securities Clearance System (CSCS) has appointed Mr. Shehu Shatali as its new CEO effective January the 1st, 2026, and that's after receiving a regulatory approval. And it takes over from Mr. Aruna Jallo-Waziri, who led the company for 8 years, driving strategic growth, modernizing systems, and strengthening governance. Now, CSCS lauds Jallo-Waziri for leaving a strong legacy, enhancing market confidence, and building a foundation for the company's future success. Let's check in with South Africa now, see how they performed at intraday. South Africa was also in the green, 0.47% at 115,000 points. And now EGX 30 is closed today for the week. And we see Kenya performing Thursday's session in red, in positive territory. I must say, in positive territory, it was at 183 points, and that's what it closed up. We'll see how it closes at the close of business today. Now, let's check in with the Middle East markets. We see how they performed at intraday. Middle East, we're talking about the UAE now, because Saudi and Qatari are closed today. And the Tada War, as I mentioned, it closed. We see Qatar also closed. Dubai was in the green. Abu Dhabi in negative territory. Now, U.S. stocks. Let's see how U.S. performed. The stock futures rose after major U.S. indexes closed higher. And this was boosted by cool inflation data that came out yesterday. S&P 500 futures traded higher at 0.3%. We see stocks futures tied to the NASDAQ also in green territory, and the Dow Jones also marginally up 0.09%. Well, let's get highlights of Thursday's activity from our correspondent, Maria Bird.
The U.S. stock market rebounded on Thursday as the Dow Jones was up at 0.2%. The S&P 500 was also up at 0.8%. And the heavy-tech NASDAQ led the way up at 1.4% up. Companies like Micron showed major growth on the day, and many investors were watching to see what will happen with the slight inflation that was seen over the past 30 days. This slight inflation could mean that we could see interest rates drop again in the near future, as we're not seeing the same rate of inflation as we have in previous months. As many are also wondering what this will mean for the U.S. economy as we close out the end of 2025.
Thanks, Maria. Now let's check in with Asia now. Japan's central bank raises policy rate to 0.75%, and that's the highest since 1995, as inflation remains above targets. And the move sent Japanese equities and bond yields higher, with the Nikkei 225 up 1.03% at 49,507 points. And consumer inflation eased slightly to 2.9% in November, while core inflation in the country held steady at 3%, and that's in line with economists' expectations. Now, the yen weakened to 156 against the dollar following the announcement. Other Asian markets we see also gained. South Korea's Kospi was up 0.65%. The Hang Seng in China was also up 0.7%. The Shanghai, the mainland China, added 0.36%, and the Nifty 50 in India also gained 0.5%. And this was boosted by ICICI Prudential's AMC's strong IPO debut in the country. Now, for a look at European markets, we're going to be joined by Lars Alter in Berlin. Lars, good afternoon. What's going on in Europe? Is the markets looking as great as it is in Asia?
Yeah, good afternoon, Will. Good to be on with you. No, it doesn't look that great here. Markets here in Europe are very uninspired today. And that is actually true for all the major indexes. So we're talking London, Paris, Madrid, but also right here in Germany, Frankfurt, the DAX. all of them down, but by just about 0.1%. So there's really not much movement at all. It's entirely unclear, of course, what we're about to see going into the final hours of the trading day. Not that there's any significant news out there that might move markets, but it is today triple witching. So that's, of course, the simultaneous expiration of stock options, stock index futures, and stock index options contracts, all expiring today. And traditionally, of course, that can lead to wild swings in the markets, and that often happens in the last few trading hours. But it's not at all an indicator of what's happening in the real world, which is, of course, why we're not often even reporting on it. But today, I guess it might be the only way to get anything going at all, looking at how the indices are not moving. There is just not much news out. Things are slowing down. It's obviously the end of the last full trading week here for the year. And then, of course, for the next 2 weeks, we'll have Christmas and New Year's. And that means we'll likely see very much lower trading volume.
Definitely, we're winding down for the year, and expected people are taking profit to have time out with their families, have fun, Lars. I know we've talked a lot about German companies being too dependent on China and how to change that, but it seems not everyone is on board right now. What are you hearing about this?
Yes, well, exactly. And all the discussion now that we've had for a long time over how to de-risk from China. We have just heard from BMW, one of the top German automakers, and they are saying they're actually unwilling to decouple from China. They're not even interested in relying a bit less on China. In fact, the company's chief purchasing director says that for the entire auto industry, it is becoming ever more attractive even to buy chips from China and to even increase dependence on that country. And mind you, this is coming only weeks after a political struggle impacting Chinese chip maker Nexperia almost forced Volkswagen to halt vehicle production. So why is it that BMW says that they, and even some other companies in the sector as well, that they all want to stick to China as their main supplier? Well, obviously it is about money. Chinese-made chips are cheaper than others, and Chinese is also far ahead of other countries, apparently, when it comes to quantity as well as quality. So far ahead, in fact, that the business community just doesn't see a viable alternative.
So is this de-risking from China now off the table when it comes to chips? Is that what you're saying?
No, well, it is most certainly not, because there are critics of the auto industry's plans to stick with the Chinese. Those critics are saying, for example, that they obviously understand the price pressure that car makers are in. After all, they're dealing with low margins after they've experienced price pressure in China and tariffs in the United States. But they're also saying, look, chips are usually sold for a few cents. So the savings per chip is minimal, in fact, compared to the cost of a car. What is not minimal, of course, is the risk a company is taking by sticking with China. Too much dependence on companies there makes chips a bargaining chip too in future trade or even in political discussions, making us somewhat blackmailable. And then, saving pennies all the time, but risking maybe a plant closure and millions in losses if something does go wrong, that might one day not look like a good idea.
So I just want to chip this in. Is there anything from the government that's possibly trying to find a way to resolve this dependence in terms of maybe create their own chip company, maybe Huawei, partnering with one of those big tech companies?
Yes, absolutely, there is, Will. And we have actually seen steps in that direction just this week. Earlier this week, actually, the EU green-lighted the subsidies Germany wants to pay to two major chip companies to start up new production plants in eastern Germany here. So there is, of course, an increased effort in making the country and making the country's industry, and I'm speaking for Germany, but also parts of the other EU countries, to make them all more independent from China. But at the same time, we have to understand that it's taking years to get these plants running. We often sometimes we lack skilled labor to work in these production plants. So we sometimes don't even have the knowledge at the same level that the Chinese have. So this is obviously a long and hard process to get more independent. But the government is on it, and it's just even more so somewhat surprising that we are hearing such voices now out of the car industry that they don't even think it's necessary.
I can understand, Lars, the technical know-how and possibly the infrastructure to get this running. We'll definitely see how that runs in 2026. Thank you so much, Lars Alter, for joining us from Berlin. Lars Alter, I'll just say auf Wiedersehen.
Auf Wiedersehen. Thank you, Will.
So now let's look in the crypto space. Let's see what's making headlines there. North Korea-linked hackers have stolen at least $2.02 billion in cryptocurrency in 2025. And that's according to new analysis from blockchain intelligence firm Chainalysis. And this marks a 51 year-on-year increase and pushing the group's estimated all-time total to $6.75 billion. And next up, we see a senior promoter of the crypto Ponzi scheme. Icomtech has been sentenced to nearly 6 years in prison for his role in the large-scale fraud operation that targeted investors across the U.S. Magdaleno Mendoza is aged 56 and received a 71-month prison term, the latest in a series of sentences tied to Icomtech. And let's say finally, Doha Bank, one of Qatar's largest private commercial lenders, has issued a $150 million digital bond on a private distributed ledger technology platform, becoming the latest financial institution to shun public blockchains. And the bank issued the floating rate digitally native notes, DNN, on the London Stock Exchange via the digital financial market infrastructure, a platform developed by Belgium-based financial market giant Euroclear. And that's what's making headlines in the crypto space. We hope to see more next week. And that's a wrap on the show. I'm Will Ibang. Have a wonderful weekend.
It's a fast beat.